the person who sort of changed the views for a lot of people here in this respect was Robert Schiller. Now, unlike Gene Fama, Robert Schiller looked at predictability over longer horizons, let's say years or even decades. And the first revolutionary finding at the time he found was that it looked like financial market prices, let's say stock prices, were much more volatile. They moved much more than the underlying dividends did. And this was surprising because actually, if markets work well, we would probably expect the opposite. We would expect dividends and earnings to move around much more than stock prices. He then went on, together with co-authors, to show that this high movements in stock price, which basically what that means is that sometimes stocks become very expensive compared to the underlying dividends, and sometimes stocks become cheaper compared to underlying dividends. And this actually implied that you could predict future movements in stock prices. So this picture here shows you a measure of how quote-unquote cheap or expensive stocks are. It's basically taking the dividends of the US stock market and divide that by the value of the US stock market. So when this is high, when the dividends divided by prices are high, stocks in some sense are relatively cheap, while other periods, we see here the late 2000s during the technology boom, dividend divided by price is very low because prices of stocks are, very high. Now, if you take this measure, dividend over price, and then you see, does that say anything about how stock markets will behave in the, next few years? It turns out it has a very strong predictability pattern here. So in periods when stocks seem relatively cheap, the dividend divided by price is high, you see, and this line is sort of the 7-year returns on the stock market following this particular year. You see much higher returns in the stock market following periods where dividends over price is high, and vice versa. Okay. So